Holger, thanks very much for joining us. Just give some insights in terms of the lending market at the moment. I guess, what are you seeing in terms of availability of debt, given that we're in this particular health crisis situation?
I would say banks are generally open for business. They do lend, but definitely at more cautious terms than they would have lent before. We see that, particularly for banks who are funding on capital markets like ours, funding costs have increased significantly, and our clients definitely note that because their costs of debt in terms of margin have increased accordingly. There are some banks who are more active than others, but the syndication market, I think, for the time being, is very quiet, particularly for those tickets who priced before the corona pandemic and are still sitting on the balance sheet of the originating bank.
In terms of, I suppose, client focus, Holger, are you as a bank looking at a difference between new, existing customers? Are there particular things you're lending on or that you're not lending on, whether that's development, operational real estate?
I mean, I can only speak for Berlin Hyp, Richard, and we are certainly open for business. I think it's fair to say there are a lot of very high quality sponsors out there I would like to do business with, even in these circumstances. From my point of view, the distinction is more between asset classes. There are asset classes which are easily financeable, like residential and long-let offices, because they seem to be less affected from the current crisis. Developments, good maybe is the right answer. It is financeable, but it may come to at much more conservative terms. So you may find yourself discussing recourse or additional guarantees or even lower leverage or higher pre-lets. Operational assets, retail, hotels and like that, very difficult to finance given that they are at the moment heavily affected, and as well, difficult to finance any investment which would rely on future rent increases, an investment which we very often have seen in Berlin, where investors would be prepared to buy into assets at low yields with the expectation of increasing rents during the term they hold the asset. I don't think that any lender would underwrite such a scenario right now.
I mean, that's interesting that you point out to that position about rents, because previously, obviously, there have been views mainly about upward rises in rents. How does that play at the moment? I'm guessing it's quite difficult also in terms of valuations, being certain about valuations at this particular point in the market.
That's a very, very fair question. I mean, we are very early in a cycle of correction, and everybody agreed before the crisis commenced that the market cycle is somewhere near or even at the top of the present cycle. So yields moving out shouldn't be necessarily a surprise for any investor. What is new is the additional pressure on rent, either temporarily or even as a trend downwards. And I believe that the short-term interruptions are going to be well managed and actively managed by landlords. Indeed, we observe in our loan portfolio that landlords are very happy to defer payments. They may even use that as an opportunity to renegotiate break options or to extend leases. So it's a give and take, like everywhere in a negotiation between the landlord and the tenant. The long-term implications, that mean the reduction and the decline of market rents, that is too early to say, but the likelihood that for some asset classes that is going to come is, from my point of view, pretty high, as those rents, particular office and retail, follow the condition of the economy.
Is there anything to learn, do you think, from previous crises, or do you think this is different? How do you think the banks, I suppose, are set up, given that the previous crisis was a financial one? Do you think the banks are in a significantly better position this time?
They probably are, Richard. The regulator has done a lot to sort of beef up the banking balance sheets with increasing regulatory requirements. Whether that's enough, I don't know, because the very big distinction is that that is not a banking or financial crisis. That is actually a crisis which does affect all parts of the economy, and banks are just one part of that. If our borrowers getting into trouble, then that obviously will have an impact on our balance sheet. The good thing is that policymakers seem to understand that. So there seems to be readiness for response, so to speak, also from the regulator to help to keep the banks in a position to act appropriately.
Very interesting to get your views today. Thanks very much, Holger.
You're very welcome. Thank you.